Great to have you on the show. Let's get right into it. I mean, there's a significant, we're seeing a significant drop in bond yields, especially in the past 2 weeks. Right now, this morning, we talked about it, about yields hovering at around 13%. Where are they right now, again? What really is behind this drop?
Yeah, good afternoon, Uche. Thanks for having me on the show. The drop in yields has been primarily driven by the announcement that JP Morgan was adding some Nigerian government bonds to their index. And effectively what that meant was that about $1 billion was going to have to flow into those bonds in order to match the index weighting that JP Morgan gave Nigeria. So that announcement came about 2 weeks ago, and ever since then there's been a lot of interest in the market, either from people positioning themselves for the index or from those who are actually buying in anticipation of what will happen when the index goes live. Nigeria joins the index on October 1st.
Well, Egie, there seems to be contrasting opinions. Very quickly, I just want to ask you to clarify. Some traders say that we saw the market shut down on Wednesday. What are your thoughts on this? The bond market actually shut down on Wednesday?
Well, I mean, in terms of that shutdown, I mean, what typically happens in this market is that there are times when the way the system works, where people are bidding and offering, and I don't think there's any clear way to tell which actual bonds change hands. So yes, the market will say there was a bid and an offer at certain prices, but what actually changed hands takes a while to know. But obviously, anytime you have a gap down in prices, a gap up in prices like now, those who are holding the instruments clearly have no motivation to sell, because there's the belief that this wall of money is going to keep flowing in well into October. So why would you sell your position now? You just simply wait a few days to get a much better return. And so the sellers might also be reluctant at times to sell because they can see prices rising.
Well, thanks so much for clarifying that, Egie. But I'm curious to know, how low do you see yields dropping?
Well, I think all bets might be off now, because, I mean, if this was 2 weeks ago, 15% was looking like a very attractive level. Now we're approaching 13, and quite frankly, as long as the buyers keep coming, the prices will keep going up and the yields go down. I mean, once the yield starts to come below inflation levels of about 12.8%, then you start to wonder if the buying is not just, if the pricing is not just simply a supply-demand imbalance. But there's really no way of telling how low they could go. I mean, before the MPR rise in October last year, these yields were about 11.5%, 12%. So we can see that as a floor on the short term.
Now, this drop in yield, it certainly contrasts with the levels or the rapid rise we're seeing in deposit rates, which seem to be in the mid-high teens. Why is there this discrepancy?
Well, I think the two markets are quite separate. I mean, we've talked about foreign investors who have to buy this instrument coming into the market. The deposit rate is really a reaction to the policies of the central bank, particularly the cash reserve ratio going up, and the restrictions on what you can do if you're borrowing from the central bank as far as the foreign exchange market and interbank placements. So what the banks are simply doing is just to simply avoid going into borrowing from the central bank to get the money in deposits. But those deposits have typically been run into T-bills, and the only way to attract them out of those T-bill instruments is to offer a better return, which is what's happening now. And of course, there's a tax discrepancy between deposits and federal government bonds, and up to a point T-bills. They're treated quite differently. Federal government bond yields are totally tax-free. So the deposits have to actually be more attractive to even equate. But effectively what that means is that the banks are trying to avoid being stuck with those kind of interbank rates we saw 2 weeks ago and just getting the money directly from the depositors.
Okay, well, Egie, I mean, very quickly, can you just tell me what the implications of these are going forward? I mean, certainly, what impact will this have on activity when it comes to the state and corporate bond market?
Well, I mean, what's happened in that market is that there's been almost no activity this year, very little activity on those states in February, one or two small transactions in between. But the benchmark for those bond transactions is the federal government equivalent yield, which had shot up to, I mean, well over 16%. And since these instruments come to the market at a premium over the federal government rates really had to come down for them to be attractive. So right now, with rates in the 13+ range, all of a sudden a state or a corporate could be looking at coming to the market slightly above that. That premium is something the market will determine, but it's been as high as 250 basis points and as low as as minus 1.3. So,
Okay.
so really at these levels, it's probably profitable for these states or corporates to issue bonds compared to getting bank loans.
Okay, well, thank you so much, Egie, for giving us your take on that. Egie Akpata, Head of Debt Capital Markets with UBA.